Right now, most Americans believe in one absolute truth, that the dollar in their pocket is the strongest and most stable currency on the planet. And if you look at the news, it seems like they're right. The dollar is still the king of global transactions and the safety reserve of every central bank on earth. But if you look at what's happening behind the scenes at the world's biggest investment banks, the story is very different. There is a silent move happening right now. While the average American trusts in the historical strength of their currency, foreign investors are reducing their exposure to the dollar at the fastest pace in decades. What we're living through isn't just a market blip, it's the end of a 15-year era that most of us haven't realized is already over. Why is your money about to be worth a lot less? And more importantly, why is what's happening to the dollar right now the first domino in a collapse that could change your financial life forever? To understand that, you need to know what the dollar was and what it stopped being. For 15 years, the dollar was the world's best asset. Every time a crisis broke out somewhere on the planet, war, pandemic, financial collapse, the world bought dollars. It was the universal safe haven. From 2010 to 2024, the dollar's value against the world's other major currencies rose about 40%. The preferred refuge asset on the planet. That's over. The analysts who manage the world's largest fortunes don't think this is a temporary scare. For them, the drop we've seen so far was just the warm-up. They projected the dollar could melt another 10% throughout 2026. And the detail is that this comes right after the currency already took an 11% hit in the first half of 2025, the biggest fall in more than 50 years. When you add what already fell to what's still coming, it's clear we're not talking about a normal swing. The rules of the game have changed. And what's bringing the dollar down isn't an isolated stumble, it's a combination of three serious problems that started feeding off each other and that the government has no idea how to stop. The Federal Reserve, the people who control the value of your money, is in a dead end. They can't lower rates because prices are still rising. But they can't raise them either because the economy is too fragile to handle it. The result? The command center of the American economy is paralyzed. They voted to do absolutely nothing, not because the situation is under control, but because any move right now could trigger an even bigger disaster. Waiting in a dead end isn't a strategy, it's a symptom. And while the Fed waits, the problem that created this trap keeps growing. The American government is spending far more than it takes in. For every $10 that flow into the federal coffers, they spend nearly 14. And the difference? They simply borrow, pushing the bill into the future through more debt and more inflation. To give you a sense of the speed of this hole, the US government is borrowing about $5 billion a day, every single day, including today. It's a debt machine that never shuts off, and the interest on that debt already exceeds $1 trillion a year, more than the United States spends on its entire national defense. There is a warning buried in the government's own congressional documents that almost nobody is talking about. The government's own fiscal accountants admit it. In this scenario, expectations of higher inflation could erode confidence in the US dollar as the world's primary reserve currency. This isn't an NGO. This isn't an opposition economist. It's the fiscal analysis arm of the US Congress itself. And while Washington piles up debt, something even more alarming is happening on the outside with the people who finance that debt. Think about it this way. A European, Japanese, or South Korean investor who bought American stocks 5 years ago didn't just gain from those stocks going up. They also gained from the dollar going up. The asset grew, and the currency the asset was denominated in also grew. Now the dollar is falling, and that changes the math completely. Foreign investors hold more than $30 trillion in American assets. To put that in scale, Europeans alone hold 8 trillion more than the entire combined GDP of Germany and France in US stocks and bonds. For a long time, they didn't worry about currency risk because the dollar only went up. Why hedge against appreciation? That math has changed. The move behind the scenes is clear. Those with billions invested in the United States have started betting against the dollar. They're buying protection, which in practice means they no longer trust the currency to hold its value. Even a small hedging move by European investors represents a significant flow of dollar selling, The logic is straightforward. When foreigners buy protection against a falling dollar, they're essentially betting it will keep falling. That bet, in itself, creates more selling pressure. It's a self-feeding cycle. That's why a weaker dollar isn't just a problem for people traveling abroad. It's a problem for any American who buys imported goods, which is practically every American. A weaker dollar means importing costs more. The United States imports everything from electronics and cars to a significant portion of the food on supermarket shelves. When the dollar loses value, those imports get more expensive and the cost lands in your shopping cart. The official projection is that your cost of living will keep rising faster than expected. In practice, your paycheck will keep losing the race against prices even with the government trying to cool the economy through high interest rates. And high interest rates have a direct cost for you. The US government has enormous debt and constantly needs to roll over the loans that sustain it, like someone refinancing a mortgage that never ends. Every time it does, it pays the current market rate. With rates high, the cost goes up. That puts more pressure on the deficit, which puts more pressure on the dollar's credibility. The cycle continues. In practice, this shows up in your car loan, your mortgage, your credit card rate, not as a future possibility, as a reality that's already unfolding. But everything I just showed you is what's happening right now. What should really keep you up at night is what already happened, and that most people still haven't stopped to calculate. Think about what $100 bought at the grocery store just 3 years ago and what it buys today. That speed of value loss is what should keep you up at night, because it isn't stopping. The very measuring stick the government uses to track the economy confirms what you feel in your wallet. The value of your money is eroding consistently. The dollar in your pocket today buys less than the dollar of 2020, and the dollar of 2020 bought less than the dollar of 2010. The pattern is the same, only the speed has changed. And now, for the first time in decades, all the forces accelerating this process are aligned at the same time. What that means for you and for what you do with your money starting today is what closes this picture. What we're seeing isn't just a market oscillation. It's the slow disintegration of the financial security your family has known for decades. The strong dollar wasn't the norm, it was a privilege. And now, the bill for Washington's inaction is arriving at your table. Not in the form of an official announcement, in the form of higher prices, more expensive credit, and a purchasing power that silently shrinks month after month. And here's what makes this different from an ordinary crisis. A weaker dollar pressures inflation. Higher inflation pressures the Fed. A pressured Fed pressures the debt. And growing debt pressures the dollar further. The domino doesn't fall once it keeps falling. If you want to keep understanding how these forces affect your money, subscribe to the channel. And tell me in the comments, are you already changing how you hold your money, or are you still betting the dollar will bounce back?